Investment analysis paralysis, wasting your days on the financial porn networks, losing sleep over short-term market shifts. These are all surefire ways to dampen your and your loved one's retirement. In today's video, I'm going to review the major market disruptions of the last 5 years, and at the end, I'm going to discuss the key to building a plan that helps you avoid selling investments while they're deep in the red. Let's start with the COVID 2020 market crash. The market dropped nearly a third of its value in a little over a month. People were at home, glued to their TVs, a bunch of job uncertainty, no idea when things would go back to normal. On top of that, looking at any investment account was super discouraging. I don't blame people who were panicking at this time. In fact, I don't know many people who weren't. But with a plan confidently in place, volatility such as this can be looked at as an opportunity. I've seen people shift their mindsets to where downward volatility actually gets them excited. We can take advantage of things such as tax loss harvesting, executing Roth conversions if that's a part of your plan. In some people's cases, they might be sitting on excess safety. This was a time to invest or rebalance some safety into the market while the market is on sale. Without a solid plan in place, it's very unlikely that you would take advantage of this market volatility, and much more likely that you will take an action that is detrimental to you and your plan. Now let's look at 2022. Not only were stocks deep in the red this year, but bonds were as well. The old conventional wisdom that short to medium term bond funds could be used as safety during these times evaporated quickly, leaving retirees with the traditional bucket strategy or the classic 60-40 portfolio left out to dry, forcing them to sell investments while they were down to fund their spending. Zooming out gives a pretty humbling perspective. This shows the market return for the total US stock market as well as the S&P 500 from January 1st all the way through May of 2025. Holding strong through the COVID 2020 crash, the doldrums of the 2022 markets, and even the recent volatility we've seen in 2025, the total US stock market as well as the S&P 500 still had an annualized return above 11% in this time frame. Now, how do we build a plan that gives you, as the retiree, confidence that you can withstand situations such as these? The answer is liability matching. You can be floating on a lake with your best friend instead of pulling your hair out, watching stock tickers and news headlines. Liability matching is building out safety in your portfolio away from stock market risk in fixed income vehicles that mature around the time your portfolio has a withdrawal need. Here's a quick snapshot of how it works. We take your monthly income needs, plus taxes and big one-time expenses, subtract out any income, and that brings us to the portfolio withdrawal need. From here, we can use fixed income products with maturity dates to build out your safety, avoiding stock market risk, as well as avoiding interest rate risk, which is what caused bond funds without maturity dates to go down along with stocks in 2022. Click here if you would like to see a hypothetical retirement audit for 55-year-old Jace Corey. If you're interested in learning more, JRS would love the chance to meet with you. Please fill out the intake form in the video description and we'll be in touch to set up an initial discovery meeting. I hope you have a great rest of your day.